Welcome back to our channel. Today, we're diving into some valuable lessons from IAS 22 business combinations. We're talking about the core principles, the common pitfalls, and how understanding this standard can give you a leg up in the world of finance. So grab your coffee, get comfy, and let's get into it. All right, let's start with the basics. IAS 22 defines a business combination as the coming together of separate entities or businesses into one reporting entity. This can happen through mergers, acquisitions, you name it. Maybe one company swallows up another entirely, or maybe they join forces to create something new. We're talking about a whole different level of integration, and that's where things get interesting from an accounting standpoint. IAS 22 gives us a framework for how to account for these combinations, and that's what we're going to unpack in this video. Trust me, understanding the ins and outs of business combinations is crucial if you want to navigate the world of finance like a pro. Now, let's talk about the bread and butter of IAS 22, the purchase method. This is the method used to account for business combinations, and it's all about figuring out the fair value of what was acquired. We need to determine the fair value of all the assets acquired, things like buildings, equipment, patents, even the brand name. And we also need to account for the liabilities assumed, like outstanding loans or customer refunds. Once we have all that figured out, we can determine the purchase price, which is basically the total cost of the acquisition. This might include cash, stock, or other forms of consideration. This difference, my friends, is called goodwill. So, we've arrived at the mysterious land of goodwill. Goodwill, under IAS 22, represents the future economic benefits arising from assets that are not individually identified and separately recognized. Think of it as the magic fairy dust that makes a business worth more than the sum of its parts. It could be a stellar brand reputation, a loyal customer base, a killer management team, or some secret sauce that gives the company a competitive edge. Now, recognizing goodwill on the balance sheet can be a bit controversial. Some argue that it's too subjective, too difficult to measure accurately. But hey, that's accounting for you. The important thing is that we understand what goodwill represents and how it's calculated. All right, let's talk transparency. IAS 22 is all about making sure that companies disclose enough information about their business combinations so that investors and analysts can understand what the heck is going on. Think of it like this. You wouldn't buy a used car without looking under the hood, right? You want to know its history, any accidents, any potential issues. IAS 22 requires companies to disclose a bunch of important details, like the acquisition date, the fair value of assets acquired and liabilities assumed, and any goodwill recognized. They also need to explain the reasons for the combination, the key assumptions used in valuing the assets and liabilities, and any potential risks associated with the deal. This information is crucial for investors and analysts to assess the true impact of the business combination on the company's financial performance. Here's the thing about accounting. It's all about comparing apples to apples. That's why IAS 22 stresses the importance of consistency and comparability when it comes to business combinations. We need to be able to compare the financial performance of companies over time, and we need to be able to compare different companies in the same industry. But if everyone's using different accounting policies and principles, it's like comparing apples to oranges. That's why IAS 22 emphasizes the need for consistent application of accounting policies and principles in business combinations. This ensures that the financial statements of companies are comparable, both over time and across different companies. And there you have it. These key points from IAS 22 offer valuable insights into business combinations and financial reporting, even if it's been replaced by IFRS 3. Remember, understanding how businesses combine, how to value them, and how to spot those hidden gems of goodwill can give you a serious edge. Don't forget to like, subscribe, and hit the bell icon for more informative content. See you next time.